Good afternoon, everyone. My name's Adrian Pano. I'm the Director of Major Projects at the Melbourne Energy Institute. And I'll be moderating today's seminar. Before we begin, I would like to acknowledge that we are meeting on the lands of the Wurundjeri, the Woiwurrung and the Boon Wurrung people, and who've been the custodians of this land for thousands of years. We acknowledge and pay our respects to their elders past and present. And for those who are online, if you also wish to acknowledge the lands on which you are currently, then feel free to do that through the Q&A function. We have got the chat disabled today, as we always do, to try and focus the discussion. I'd also ask for those who are online to respect our presenters, both Keith today and others, that we endeavour to have these presentations and webinars as informed and knowledgeable and as open as possible. And as part of that relationship, we also ask that you respect that you don't record the slides. And that way we can have the most open and direct and meaningful discussion. So thank you for joining us again today, as many of you have throughout this series on energy commodities. And we've already had many interesting seminars, both on commodities that are used directly as an energy source in Australia and those that we export for use elsewhere, such as the previous seminar on nuclear. In terms of questions, we'll have a chance for questions at the end of the session, both live and via the Q&A function online. Our speaker for today, Keith Handbury, is joining us from Brisbane. Very grateful for you to have made that effort. And Keith has been working in energy markets in Australia and in the UK for the last 15 years. Since 2017, he's been working at Shell Energy Australia as an energy trader, specialising in electricity and environmental products. Keith has a background in mathematics and economics with a Bachelor of Science with honours in maths from the University of Sydney and a MSc in econometrics and mathematical economics from the London School of Economics. So we're particularly pleased to have Keith here in this very complex and an area of energy where a commodity is not a commodity until you actually put a value on it and start trading it. And yet the trading part of the whole energy market is often the most or the least understood and the one that can make a company go well or can make it go very badly. And we're certainly seeing that in the current market. So Keith, thank you very much. Over to you.
Thanks very much. Is that's good? It's the right green? Yeah. Great. Look, yeah, hi. As he said, my name is Keith. I've been in and around energy markets the last 15 or so years. I'm from Sydney originally. I graduated in maths first. So I actually worked initially in foreign aid for 4 or 5 years before moving into the energy space. I did this master's in economics and then started working in gas and power in the UK and have worked in gas and power markets in Australia the last 12 years. So the last 5 or 6 years almost, actually, I've been in electricity primarily, which has been, look, it's a super exciting, fun space. I think, you know, I suppose if there's one message I want you to go away from today is just, you know, trading is a super interesting, exciting area. It gives you a real insight into the way that markets work. It's a little bit complicated, so I'm going to try and take things from the beginning, just explain some of the kind of more basic concepts in trading, some of the reasons we trade, how we trade, what kind of products we trade, where we trade them, some of the controls and the way we manage our business when we're trading. It's going to be relatively basic, but there's a lot of information. So hopefully I've pitched it at the right level. And obviously specializing in electricity and environmental products myself now, I'll give you a little bit of a kind of introductory idea of how we hedge electricity exposures and what the types of products we trade and how that's changing over time, because I'm sure, as you're all aware, things are changing a lot over time. So look, I thought I'd start by telling you a little bit about Shell and giving you a bit of background as to why we're involved in trading and some of our trading activities in Australia. So look, as I'm sure you'd be aware, Shell's a major player in a lot of energy markets around the world. Australia is a big focus for us. We're operator of a couple of the largest LNG projects in the country, one in Queensland, the Prelude floating LNG project off the west coast, and we also have large shares in a number of other LNG projects. And then also we have quite a big footprint in the marketing of energy products. So probably the most obvious example is you go into a Shell petrol station, you buy Shell products at a petrol station. So as we'll talk about today, operating in both the kind of the production and the marketing sides of the business, it sort of necessitates a presence in trading. And trading is something that I think Shell prides itself at being pretty good at. It's a fairly major player in almost every major energy market all around the world. I've given you a sort of laundry list of some of the products we trade: gas, power, oil, refined products, environmental products, freight. We have pretty large trading businesses in all of these areas. And they're a really important part of our business in terms of they're a bit of a facilitator for our upstream and downstream businesses, and they're also a big, they generate value in and of themselves if you can get good at them. So one thing that people are often confused when I say I trade electricity and I work at Shell. They go, "Oh, but you're the oil and gas company." So Shell, along with a number of the larger, oil and gas companies, there's kind of been a realization these past 10 or 20 years that the system is changing, as we all know. So right now, about 50% of our energy comes from oil and gas, and about 20% of our energy comes from electricity. In 30 years, we expect that to have flipped. So oil and gas to only be 20% and electricity to be 50%. So anticipating this transition, companies like ours will need to change with the times too. And Shell Energy, which is Shell's effectively our electricity businesses, that we're our energy marketing businesses, are part of what we're trying to do there. So Australia is a big focus country in terms of Shell's move into the electricity space. So there's been a few big changes we've made. We established Shell Energy back in 2017. That's when I was hired, setting up the power trading desk. And since then, there's been a number of reasonably large steps we've made. So in 2019, we bought ERM, which was one of the, probably not a household name, but it was actually one of the largest retailers in the country, but it focused on retailing to commercial and industrial business customers, basically. So we are now one of the largest retailers to businesses in Australia. We've sanctioned a number of upstream generation projects. So the Gangari solar farm was sanctioned in 2020. We've taken on a number of offtakes from wind and hydro assets since then. And just this year, only a couple of months ago, we sanctioned the Rangebank battery, which is a 200 megawatt 2-hour battery not far from here at Cranbourne. We've also acquired PowerShop, which is a mass market retailer. So PowerShop might be a name you're more familiar with when you're looking at purchasing electricity for your home. Now, underpinning everything we're doing here is a big focus on trading. So a strong trading business is crucial to us. And part of that is because we don't always have a perfect balance. We're a much bigger retailer here in terms of our load than we have upstream generation. So we need to go and source a lot of our generation from the market, and trading. So having a strong trading business is crucial for that. So I thought I'd just start from the beginning, I guess. So what is trading? So look it up in the dictionary. Trading is the purchase or sale of goods and services. So you often hear the word trade used, trade between countries. So trade, overseas trade partners. That's talking about buying and selling goods and services between different countries. But in energy, when we talk about trading and we talk about the way we use trading in energy businesses, it's a bit more of a complex picture that's driven by risk management. And a lot of that really, what it all comes down to is businesses having the certainty to make investment and spend money to keep the economy going. They need trading, they need traded markets to be able to be sure that they're going to get a return on their investment. So let's have a think about like a couple of basic examples of how that might be the case. So energy producers. So often for energy producers, there's a large upfront investment. So you think of a solar farm or a wind farm or a pumped hydro plant, or in this case, the example I've given here is an LNG project. That's got like a $10 or $20 billion at least upfront investment. So the majority of the money you're spending on that LNG plant, you're probably spending before it produces anything. So you want to be sure that A, you can lock in a reasonable amount of that production that it's going to produce at a reasonable price. And for the production that you don't lock in the price at today, you want to have confidence that there's going to be a market that you can go to and sell your production into. You're going to be able to find customers. And these are traded markets, whether it's long-term markets or short-term traded markets. It's the same for energy users. So they're making decisions about investments themselves. And there's a lot of, almost every business is using energy, but a lot of businesses, energy is an extremely important input cost. So if you think about at the extreme end of the scale, an aluminium smelter or an ammonia plant, the electricity or gas that they use is often well upwards of 30% of their input costs. So if they're making investments or making commitments to operate their plants for a period of time into the future, they're going to want to be able to lock in the energy price that they're paying, and traded markets give them that certainty to be able to do that. So for both producers and users, it's all about traded markets giving people the certainty that they can lock in their price, market their product so that they can make investments and keep the economy moving. So who is participating in traded energy markets? So look, we just talked a little bit about producers and consumers, and I've kind of listed 3 columns here, 3 different types of market: the electricity market, LNG, and environmental products, and the different types of players and who they might be in each. So if you think about producers, you know, there's different levels of complexity in terms of their involvement. So a rooftop solar installer. So when you install rooftop solar on your house, that rooftop solar installer generates small scale technology certificates. They're a type of environmental certificate that and there's a large traded market for these STCs, they're called. So that rooftop solar installer will need to get involved in that market, often via a broker, to sell those certificates. But then you can have more complicated involvement in energy markets. So a gas-fired power plant might be an example of that. So the reason it's more complicated, well, they're dealing in 2 commodities. So they need to buy the gas to run their plant, and they need to sell the power. And maybe they're not needed all the time. So if they're not certain if they're going to be running at a certain point in time, so often they're going to be selling options over their capacity instead of necessarily buying the commodity. So there's different levels of complexity. We've talked about some of the consumers. I mean, but basically every business has energy as an input. There's various levels of that. Some of them will interact with the energy market directly and have their own trading operations, and others will do that through retailers. Developers. So developers are companies that, like a really good example of developers is in Australia. So most of the solar and wind power that we see developed around Australia isn't owned by the people who develop those projects. There were developers that found the site. They made an agreement with a landholder to build the solar or wind farm on the site. They might have gotten the approvals, the development approvals. They would get the connection agreement with the transmission operator. They'd probably go and find a customer for the output. And then they take that project through, construct the project. And then once it's constructed and all the risk is taken away, they might then sell that project to someone that's looking for a sort of stable investment, a pension fund or such. So these developers are another different type of player. They're not necessarily a long-term producer or consumer, but they're involved in the markets. They're involved in the markets also. Now, retailers can be heavily involved in markets. I sort of alluded to the situation, Shell's situation. So In Australia, a lot of, particularly in the power market, you think about our power market, we're dominated by a lot of gentailers. So you've got companies like Origin, Energy Australia, Alinta, AGL that have large upstream, have large generation positions and matching retail positions. But then there's a lot of players that might not have any generation position, and they might go and sell to customers and then use the market to source that production. So that allows for more competition. Having people who can come in who don't necessarily have generation assets allows for more competition. And electricity market's probably a good example of where you've got quite a lot of retail competition, because there's lots of smaller players that might be really good at the customer relations sort of stuff, but don't have the upstream, the generation to back it, and they can use the market to back it themselves. Transporters. So when I say transporters, think about things like pipelines or ships that are transporting energy. I might say the transmission system in Australia, but the transmission system in Australia, there isn't so much trading of rights in that transmission system. When transmission operators build their system, they get a guaranteed regulated return. But gas pipelines are different in Australia. So gas pipelines, a lot of those are built based off commercial returns. And you might see pipeliners involved in the traded market. There's trading of capacity rights for pipelines. Shipping, there's a quite liquid market in shipping, in capacity on different types of ships. And then finally, intermediaries. So these are people who don't necessarily have any physical connection with the market, but they can often play an important role. And the kind of players I'm thinking about, banks, hedge funds, international trading houses, people who are involved in the market due to their ability to manage and take risk in the market. So like a couple of functions that these sorts of players might perform. So one is market making. So say you come to market on a particular day, you're a retailer, you're an electricity retailer, you've just signed a bunch of new customers, you need to buy that electricity from the market today. Now, what happens if there's no seller out there? What happens if it just happens to be that there's only so many sellers out there and none of them have come to market today? You can't wait a week or two for that seller to come to market. So you'll often get one of these intermediaries that will step in and they'll say, look, I'll offer you that product at a small premium, and then I'll take the risk and back myself to be able to buy that back in the market when the sellers come to the table. Another key function these types of players perform is making the market more efficient and more price reflective. So oftentimes, efficiency in markets effectively means that prices reflect the fundamentals of the product. And it's important to have efficient markets where prices are reflective so that people get clear investment signals. If you've got prices lower than they should be, and really prices should be up higher, but for whatever reason, the prices are trading at a lower level, then it might not give the investment signal for people to build more production capacity of whatever particular commodity we're talking about. So speculative players like a hedge fund or a trading house might come in and say, look, that price is too low. I think in time that's going to need to go up. So I'm going to buy that product. And they'll often, just that act of speculating will often drive prices closer to where the efficient price should be and provide more accurate investment signals to the market. Okay, so look, I've got a bit of a laundry list of commodities here. I figured it was probably worth going through them because they're all a little bit different. The way we trade commodities is quite different between all of these. And I just thought I'd highlight some of the key differences because differences about the products change the way that they're traded. So oil and oil products. So oil is the most heavily traded commodity in the world, easily the most liquid commodity market, energy commodity market in the world. It's a truly international market. And when I say that, you think there's a lot of countries out there, Australia is one of them, that source most of their oil from overseas. They don't actually produce it onshore. So you need this international oil market to provide the oil that people need. So standardization is a common feature of a lot of these markets, and this is true in oil as well. So standardization with energy products, you often get, it's not always, they're not always completely fungible. There's slight differences. They're not always completely homogeneous. So there's slight differences between, certain types of oil might have slightly higher impurities or slightly lower energy levels. So often we see standardization around a couple of products that have a particular specification, a particular energy content, a particular level of content of certain impurities, and a particular delivery point. So in the case of oil, the names you'd probably be familiar with are Brent crude oil. So that is oil that's delivered at one of 4 ports in Europe and meets a certain specification. And then the other most commonly traded type of oil is West Texas Intermediate, or WTI, which is delivered via pipeline in Oklahoma. Now, coal is another very international commodity. A lot of international trade in coal, lots of coal being shipped around. And it's quite interesting in that there's a really wide array of different qualities of coal. So if you look at like the lowest energy content coal versus the highest energy content coal, the high stuff is going to be double the energy content of the low stuff. And there's all sorts of other stuff you can find, as you can imagine, when you're digging stuff out of the ground, different types of impurities. So you get a real range of different types of quality of coal, and that makes it a little bit more difficult to trade, making it less homogeneous. But we do have a variety of standards around the world. The main one we trade in Australia is Newcastle coal, which is out of the port of Newcastle, and meets a certain energy content there. So interesting thing about gas and electricity, this is true of both gas and electricity, a key feature about these markets is that they're more localized. They're less international, and that's because it's more expensive to transport gas and electricity. So if you think about gas and you look at Australia, we've got a very clear gas market on the East Coast and the West Coast, and there's no big pipeline joining the East Coast and the West Coast because it's way too expensive to do. It wouldn't pay for itself. So you tend to see that gas markets are a lot more localized than other markets like oil and coal. However, in recent years, the transportation of gas via ship has become more prominent. So this is LNG, liquefied natural gas. If you liquefy gas, put it into a big fridge, chill it down to below minus 160 degrees, it becomes liquid, which is about 600 times less volume than the gas. Allows you to put it on ships and send it around the world. And more we're seeing a liquid LNG market, trading of LNG cargoes, which is starting to link the different markets. So when you saw the troubles in Europe and the Russia-Ukraine war last year, when you saw that being exported to Australia, LNG is part of that. It's part of the linkages around the world, and it can go both ways. Then electricity is another very localized market. Again, electricity is expensive to transport over long distances. So again, we have a East Coast and a West Coast market that aren't linked at present. And so you often see, and even on the East Coast, you often see big differentials in prices between Queensland, New South Wales, Victoria, and South Australia. That's because there's limitations on how much electricity can be transported between those places. And this is really playing out now. The cost of transportation is one of the key things that we're trying to sort out as we try and bring more renewables into the system. The problem that we have is that renewables are often in far-flung places. Far North Queensland has got amazing wind, or Western New South Wales or Western Queensland's got good solar, and you need big transmission links to get that generation to the city centres. Transportation markets, we talked a little bit about that before. So you often see transportation in freight. So there's shipping markets and standardized shipping products that trade. Pipeline credits are also quite liquid in Australia as well, and around the world. And environmental products. So this is an interesting one. It's kind of one that is a little bit, it's not naturally, that people don't naturally think that there would be a big trade in it, but actually it's one of the most liquid products traded in Australia. And it's another thing, as part of the electricity market, I trade every day. So renewable energy certificates are a good example. So the Australian Renewable Energy Target was established, I think, back in the early noughties. And basically what that does is it creates a target for the country to have a certain amount of renewable generation each year. And the way it does that is it says that renewable generators will produce a certificate for every megawatt hour of renewable generation they produce. And then anyone that consumes energy, which is retailers on behalf of their customers, they need to buy a certain number of certificates to allocate to their generation so that a certain proportion of their generation is effectively allocated as renewable energy. And since the establishment of this scheme, the renewable energy certificates, the main certificate being large-scale generation certificates, that has become an incredibly liquid market in Australia. And we have as many people trading renewable energy certificates each day as we do power. It's as important to us as power, and it's good for, it's good because it provides a clear price signal to renewable projects. It provides confidence to renewable projects that there is a liquid market that they can sell their output into as and when they need to. And carbon credits are probably the other one. So there's quite a liquid market in carbon credits all around the world. In Australia, we have ACCUs, and I think we're expecting that to, as the obligations on businesses to source more carbon credits grows, we're expecting that to grow in liquidity over time. So the types of products that we might trade. So obviously basic purchases and sales, you just buy or sell the commodity, certain volume at a certain point in time. That's the most common. However, options are very commonly traded in energy. And the reason for that is that there is a lot of there can be a lot of variability in energy demand, and there's a lot of supply sources that can help provide that variable supply. So if you think about options, why would we trade options? It's typically when we're not sure how much we're going to produce or how much we might need. So take the example of an airline. So it's got highly variable jet fuel prices as an input, and it wants to be able to confidently put a price on its ticket that it knows it's not going to lose money on. But what if it sells way more tickets than it thought? It has to put on more flights, and then the price of jet fuel goes up. How does it manage that risk? Well, it doesn't want to buy the jet fuel beforehand, because what if it doesn't sell the tickets? It's not sure how many it's going to sell. So what they can do is they can buy an option. So this would be called a call option, which gives them the right in the future to buy that jet fuel at a fixed price. So if they sell the tickets, great, they've got the right to buy the jet fuel at a fixed price. But if they don't sell the tickets, they don't have to buy the jet fuel. They've got the right, they can match their supply to their demand. So this is kind of one of many examples of how options are used. And we'll talk a little bit more about towards the end around how we use them in the electricity market as well. So spreads and swaps are another common product that we sell, that we trade. So if you think about time spreads, this might be where you're buying at a certain point in time and selling at a later point in time. So we talked about the gas market. So a feature I didn't mention about the gas market is that it's highly seasonal. So here in Victoria, gas demand is, I believe it's more than double in the middle of winter. On the peak day of winter, it's more than double the lowest day in summer. And that's because in winter, everyone's using gas to heat their homes in Victoria. So often you find we need storage. So basically we've got assets which are producing a fixed amount throughout the year, but we need a way to take their production from summer and put it into winter. So we have storage assets that are able to do that. They'll inject the gas in the summer and withdraw it in the winter. And they will trade time spreads. In order to monetize their storage asset, the way they will do that is they will sell that time spread to people. They'll say, well, I'll buy from you in the summer and sell back to you in the winter. Location spread. So this is where you buy at one place and you might sell at another place. So this is the kind of thing someone who owns transport might do. If you owned a ship, an LNG ship, or if you owned a gas pipeline, or a electricity transmission asset, then you could buy at one place and sell at the other and use your transportation to transport that product. And commodity swaps. So sometimes you will buy one commodity and sell another commodity. So a good example of someone that might do that might be a gas-fired power station. So they're taking gas in, they've got the ability to convert gas into power by using their power station. So they might do swaps where they'll buy the gas and sell the power at a fixed spread. Okay, so I thought I'd go through financial versus physical. So it's a key concept because financial trading, physical trading and financial trading is kind of two sides of the same coin, but they're quite different in the way that they work. So physical trading is what you would think it is. It's paying a certain amount of money, agreeing that I'm going to deliver you this commodity at this time and this volume at this place at this price, and you're going to pay me a fixed price. Now, if I'm a buyer, it locks in my price. I know I need X volume of commodity. I'm going to pay volume times the fixed price in the future. I've locked in my price. But I can do the same thing with a financial contract. So a financial contract is similar to a physical contract in that the buyer pays a fixed price, but the seller, instead of delivering the physical commodity, they pay the financial value of the commodity at delivery. So most commodities, there is a spot price. So in the future, there's going to be an agreed value of the spot price at a given point in time of what that commodity is going to be worth. So instead of me delivering you the commodity, I'm going to agree to pay the spot price times by the volume of the commodity that you're paying for. So if you think about the buyer's exposure, the buyer knows they can buy the volume they need, the physical volume they need at the spot price in the market. And if they then on top of that agree a financial contract whereby they pay the fixed price and receive the spot price from the seller, then if you combine these two together, those two will cancel out, and what they'll be paying at the end is the same as they would have paid if they did a physical contract. They'll end up paying the fixed price for their volume when you net out the financial contract and the spot purchase. So they're a little bit different in terms of barriers to entry. So obviously a physical contract, in order to be able to trade physical contracts, you need to be able to deliver or take delivery of the physical asset. So in some cases, that's quite tricky. It's quite a high barrier to entry, if, for example, in gas, to get access to pipelines and nomination systems. And it's quite a high hurdle. On the flip side, a financial contract generally comes with increased regulatory requirements in terms of financial compliance. So in terms of how trading is facilitated, there are two primary ways that we would do our trading. So the first is through an exchange. So with an exchange, you have a central body, the exchange, which defines the way trading happens. They define what the products are, what the specifications of the products are. They manage all the bids and the offers. They usually provide a system where you can bid and offer your product, and they'll generally match buyers and sellers together, and they'll manage all of the kind of administrative tasks around the trade. Another thing that will typically happen with an exchange is that you don't know who you're dealing with. When a trade is agreed via an exchange, you actually don't agree with the person on the other side of the deal. You don't have a contract with the person on the other side of the deal. You both have a contract with what's called a clearing counterparty, which is usually set up by the exchange, which is a financial counterparty which basically agrees to execute opposite sides of the deal with each of the two counterparties, so that net, it should make or lose nothing in the end. But the buyers and the sellers, they both have a contract with a relatively reliable financial counterparty that they know is going to be able to is going to be reliable when it comes to paying out on their contract. Now, along with that, there's typically quite high credit requirements when you deal on an exchange. So for example, if I sell a product on an exchange, if I sell 1 million barrels of oil on an exchange at $50 a barrel, it's worth $50 million. But say the oil price goes up to $100, from $50 to $100, the oil I've sold is now worth $100 million. So that contract is now out of the money for me by $50 million. Typically with an exchange, they're going to ask me to give them that $50 million in cash or in a bank guarantee. They're going to ask me to fully cover that exposure with them. So it can have quite high credit requirements in terms of being able to source the cash or the bank guarantees in order to be able to provide confidence to the exchange that you're going to be able to meet the terms of the contract when it comes to delivery. Now, over-the-counter trading is different in that, as opposed to an exchange where you deal with the exchange and through the exchange, over-the-counter you deal generally directly with another counterparty. So over the counter, the expression I think comes from the idea where you used to walk into a bank and agree a contract with them over the counter. Now, typically, before you do any trades, you will execute a master agreement with a counterparty, which kind of specifies some of the key terms about how you might trade. So like if we agree a deal, the money will be paid 5 days after delivery, and we'll send things to these email addresses. And if one of us goes bankrupt, here's what's going to happen. And then when you agree individual transactions, you might just agree the volume and the price. Now, prices can be negotiated directly. You can call the counterparty up directly and agree with them a price, or you might be dealing through brokers. So you might be calling up brokers throughout the day, and they might anonymously be matching people. But then, of course, once you are matched, you're agreeing a deal with that counterparty. So as opposed to on the exchange, you never know who you've traded with. With over the counter, you know who you've traded with at the end of the day because you have to execute that contract. In general, there's less transparency with over the counter trading, even though you know who you're trading with compared to an exchange. Typically, a lot of over the counter trades are not published anywhere. No one knows about them happening. Whereas all exchange transactions, all the bids, the offers, the prices are very visible to everyone. So when you see electricity prices published in the newspapers, futures electricity prices, it's because it's happening on an exchange. Another thing about over-the-counter trading is that you can, whereas you'll have really onerous credit requirements, where in that example where the oil price went from $50 to $100, you had to front up the $50 million. With over-the-counter trading, you might not necessarily have such onerous credit requirements. For example, if I'm dealing with you and I know you've got that oil field over there that's producing oil, I know that you're going to have the oil to deliver me next year, even though the price has gone up to $100. So I don't necessarily need you to post that $50 million to keep me confident that you're going to be able to deliver the oil. I know that you've got the production to deliver. So you can be a little bit more flexible around credit, and that can be quite important. So I thought I'd just really quickly go through some of the key risks that we
Yep. That's it.
Good, great. So credit risk, if your counterparty can't fulfill their obligations, and we're constantly monitoring how many trades we've got on with different types of counterparties to see what is the potential for loss for our business if one of our counterparties goes broke. Liquidity risk. So you might come to market to try and buy a product, to try and buy or sell a product, but maybe the product isn't there to buy or sell, and maybe there's not a market maker to buy or sell it for you. So you might think that you've made money on a trade, or that you think you can manage your exposure, but you can't actually when you go to the market because the liquidity isn't there. But another example of liquidity risk is when you run out of cash. So we talked about that example of margining with an exchange, whereby you maybe sell that oil on the exchange and the value of the oil goes up, and you need to post a whole bunch of credit. So this can cause havoc in situations where we get extreme price moves. So last year is a good example of that, particularly in Europe, where we had really extreme price moves of European power forwards. We had a lot of generators that had sold large volumes of contracts on the exchange. And even though they had the generation to back those contracts, they were going to be able to meet the conditions of those contracts, because the price went up so much and they had to provide so much credit to the exchanges. A lot of them ran out of cash and couldn't meet the requirements. And when you heard about I think the European Central Bank providing liquidity to the markets and the UK Central Bank providing liquidity to the market, That was what was happening. They were providing cash to help those generators meet their requirements on the exchange. Since that happened, prices have come way back down, and those credit requirements have gone away. So they've kind of, but a lot of them could have gone broke in the meantime, just from the large fluctuation of prices. And the last one, I suppose, is operational risk. So this is where maybe something in your processes goes wrong. You don't properly record a trade, or you don't properly capture a risk in your business, and the reporting around these risks goes wrong. So look, really briefly, I thought I'd go through the power market and how trading in the power market works. Again, it's a bit high level 101, but it gives you a rough idea of the types of products that we're trading and the way that's changing over time. So we talked about physical versus financial markets. So the electricity market is typically a purely financial market. Now, the reason for that is that the spot market in electricity needs to be managed by a central operator. So there's no storage of electricity. There's no room for error in any given moment in time. You need to have a good balance of the amount being supplied and the amount being consumed. And for that reason, you need a central operator manage how much is coming into and out of the system. And AEMO does that, and it runs a spot market that sets a spot price every 5 minutes. And all of the contracts we trade are financial contracts, those financial contracts like we talked about earlier, that settle based off that spot price. So when you hear someone talk about buying electricity for next year, they're not buying a physical contract to deliver electricity next year. They're buying a financial contract where they're going to get paid. They'll pay a fixed price and they'll get paid the spot price. And then when they buy from the AEMO spot market, they'll be able to use that spot price they receive under the financial contract to lock in their price. So the most common type of contract we trade is a future or a swap. Like I said, a buyer pays a fixed price for a fixed volume, and the seller pays the buyer the spot price for the same volume. Now, with electricity, a key feature of the electricity market is that demand varies throughout the day, and there's not really much storage. So you need to be careful about managing that demand supply balance. So this black line up here is a typical demand line. I think it's about, I took 10% of the market from Q1 about 5 years ago in Victoria. So that's a kind of typical system demand for Victoria. And how you might hedge that average demand is shown. So along the x-axis here, you've got midnight to midnight, and here is the amount of demand. So you might hedge that using some baseload contracts, which are this grey block here. They're supplying you, they're paying out for every hour of every day. But we also have time-based contracts. So there's a peak contract, which delivers from 7 a.m. in the morning till 10 p.m. at night. And you can see that's quite a good fit for this demand shape, because demand is low in the overnight period from 10 p.m. to 7 a.m. But then during the middle of the day, demand is higher. So the peak contract's quite a good fit for that. Now, we talked a little bit before about how demand can be variable. And this shows you from that same period, which I think is 2019, Q1 2019, this black was the average, but this dotted line, that was the peak day. So you can see that the peak demand, that Q1 was almost double the average the demand in that quarter. Now, it's tricky how you're going to manage that, because you don't want to buy more peak swaps to cover that, because 99 days out of 100, you're not going to need those peak swaps, and you might lose money on them. So this brings us back to that jet fuel example of the option. What you'd like is an option that's there on the day for you that protects you in case demand goes high. So options are quite liquid in our market for this reason. So the classic way that you would manage this is using a cap product. So a cap option is basically an option where you pay a premium for all the hours of the day, and any 5-minute interval where the price goes above $300, you will get a payout for the amount it goes above $300. So if it goes to 1,000, you'll get a payout of $700. If it goes to 2,000, $1,700. So if you buy this yellow section of caps, then you're now covered for any prices that happen above $300. And those are the prices that you're really scared of, particularly on a big demand day like this. On a high demand day, prices are likely to be higher. So that's the risk that you really want to take off your books, and cap contracts allow you to do that. Who's selling cap contracts? Well, generators that can turn on and off at short notice are selling cap contracts. So think hydro. So we've got a lot of hydro in Victoria. You've got Snowy Hydro, the Murray plant. You've got a lot of hydro generation coming up from Tasmania, from Tas Hydro, Hydro Tas. So those types of plants, gas-fired power plants, can turn on at really short notice. So anytime it looks like the price is going to go above $300, a gas-fired plant can turn on. And more we're seeing batteries perform this function in the market. So batteries can turn on. They're the quickest of all. They can turn on in an instant. And so they're also a natural, not necessarily a natural seller of caps, but a natural seller of optionality that helps covers these types of risk. There's another couple of types of options that we trade in our market. We trade average rate options, which settle based off the average price, if the average price goes above or below a certain level during a period, and swaptions, which they give you the right to execute a swap in advance of a period. So for example, if you bought a Cal 24 swaption in November, you've got the right to buy or sell a swap at a certain price in advance of that year, but I won't go into too much detail. So if you look at that picture on the top right-hand side, things are changing now. So that's 2019. If I go down, this is more like today. So key changes. So if you look at the black line, as opposed to the black line being at its peak in the middle of the day, it now dips down in the middle of the day. So that's because most of us have installed, well, many of us have installed solar on our roofs, and we don't need as much electricity during the day that we used to in a hot summer. The other problem we have, the other issue that is arising in the market is that as more of the coal-fired power stations close, the coal-fired power stations are the natural seller of these kind of baseload contracts because they're running all day. They're the natural seller of those. Whereas a gas-fired power station or a solar or a wind isn't running all day. It's not as well equipped to sell those types of contracts. Coal is. So coal is the classic seller of these types of contracts. And gradually coal is coming out of the system. So we've got less of that baseload energy. But we are replacing it, and we're replacing it with solar and wind in terms of the energy. But they're a variable supply. So solar is generating during the middle part of the day. So it helps you here and it covers you here, but it doesn't help you so much in the overnight periods. Wind can generate more in the overnight periods, but it's variable. You can get low wind days and you can get high wind days. So you can see on a low wind day, all of a sudden we're quite short where we don't have enough production for large chunks of the day. And then on a high wind day, we're looking better in the overnight periods, but we've got a lot of excess production during the day, which we can lose money on. So what we're seeing now is more products to help people manage these types of exposures. So people will buy and sell fixed solar profiles. People will buy and sell these overnight periods here, or they might buy and sell this super peak period here in the evening. And they're kind of different shape profiles that are helping people to manage those risks. We talked about storage. Storage is becoming more prominent in the market. So the classic types of storage in our market are batteries and pumped hydro. And more projects like these are being developed. And those types of projects will be able to sell kind of virtual storage products into the market where they might buy electricity from you at the lowest price points of the day. So maybe on this day, they might buy electricity from you here and they might give it back to you here. Well, they might be able to buy electricity from you on this day and then give it back to you on the day when the wind is lower. So we're seeing more and more products like that traded. And we also see a lot of weather-linked products trade as well. So we've always been a weather-linked market. On the hot days, you've got higher demand, but we're becoming even more weather-linked as we've got more generation now that's linked to weather. So we're seeing more weather-linked products trade. So look, that's kind of what I had for today. I hope it wasn't too in-depth. I hope it was the right level. But I suppose just one thing I wanted to say is that, for anyone that's considering what direction they want to go in the energy market, I just say that trading it's awesome. You get an insight into the way the market is changing. I mean, it's very exciting. It's not the greatest I was saying to a friend today, like you don't get so much flow in your day-to-day work. You're constantly being interrupted, but you're right at the coalface of all these changes that are happening that everyone's talking about. And you know, the market will tell you before anything if something needs to change, or if something's working or it's not working, or if it needs something. So it's a really exciting place to be. So yeah, I'd encourage you to consider it. Thank you.
Thank you, Keith, for filling in a few gaps, I think, for a lot of people about the complexity of the market, and particularly the trading that is constantly happening, 5-minute intervals. This process is not something that happens once a year. It happens constantly. So questions from the floor? Yes.
Hi. We have a solar energy business. There was an article in Renew Economy the other day about spot prices. They went up to like $15,000. And there was something about the regulation and how there were all the bids that were at a reasonable price. And then suddenly someone bid very high, and then all the other traders get that price.
Yeah, so I mean, look, the way the market works is that the marginal supply into the market is what sets the price. So they look at, everyone bids in at certain prices, and there'll be a kind of stack of all the bids. They order them up, and they take the cheapest combination of supply they can find. And sometimes that supply can be priced up to a maximum price in our market is now $16,600. So the price can get up to those levels. Usually that's only in periods of acute shortage of supply. So, you know, really something that people are very conscious of these days is that those periods of acute shortage where you get the start of the week was a little bit like this, you know, there was not much sun, not much wind. It doesn't happen often, but when it happens, you can get quite an acute shortage. And, you know, I think when the prices go to that level, that's kind of the reason they allow prices to go to that level is to provide that investment signal for new backup generation and storage and batteries and pumped hydro, this sort of stuff to come into the market. In terms of the actual behavior in this example, I'm not across that particular article, but yeah.
So very much related to that question, I think I had one online, and just looking at the current NEM pricing, New South Wales, Queensland is sitting in the +30, South Australia and Victoria -50, $55, $57. So the question was, you see that the media reports it in a whole lot of confused sort of prices are negative, we're all going to die of lack of an economy. But the reality is that most energy is hedged, most electricity is hedged. So is that actually correct, that the NEM, the dispatch price, really, the price paid is almost never negative?
Look, I don't know if I'd say, you know, it's a little bit different. So the gas market is probably a little bit more like that, where the spot market on a day is really just a very small amount of balancing energy. I would say there is a fair amount of energy because things are so variable in power and supply is so variable and demand is so variable. No one is ever perfectly hedged. So those prices do matter a lot more, and they can provide a signal for the future. But on the flip side of that, you know, I think those things move around all the time. You know, one characteristic of our prices is that, you know, on the super windy, super sunny days, you can get negative prices if there's low demand and super high wind, but they can be just as high on the other days, so that, you know, it all kind of balances out a little bit in the long run. And, you know, some of the things I remember maybe not 3 years ago, people were saying, oh, solar generation is no longer worthwhile. The prices are they're going to be negative all the time. And then last year, solar generation was super valuable. So it moves around a lot. So it's really difficult to take the price at one 5-minute interval on one particular day and one particular set of circumstances and draw too much from that.
Thank you. Anyone else from the floor? We have one other question online then, which is slightly different, that it's to do with carbon price.
Yeah.
And it's how do you how responsive is the market to different carbon prices? How do you set that? How do you project it?
Yeah, well, look, it depends on the market. So in terms of carbon prices, so there was, the 10, 15 years ago with the first carbon price that was set in our market, that applied to the electricity sector. And we saw it completely changed the way our electricity sector operated. And we could see a very clear link where the carbon price came in, and it was all priced in exactly as you would expect it to be, based off how much carbon the coal generators would emit. They were going to have to buy, they had to buy the certificates, so that their bids changed and the gas bids changed. It's less. It doesn't have that direct impact anymore in the power market, because the power generators are no longer liable for their carbon emissions. Instead, the drive towards renewable has come from the renewable energy target and renewable energy certificates, which has been, look, it's kept things going apace, but it's a very different type of price signal. But you do see those renewable energy certificate prices play out in people's bids. So the reason prices go negative on certain days is because if I'm a renewable energy generator and I generate a megawatt hour in the middle of the day, if the power price is minus $50, but I'm getting $60 for a renewable energy certificate, I'm still making money. So I'm happy to keep generating at minus $50.
Okay. Oh, one from the floor.
Yeah, hi there, David. Just on the RET process and where we're going, my recollection of the last lot of graphs I looked at was that the price for the forward price, if you like, of the renewable certificates was falling up until theoretically the close of the process in 2030, is my recollection. What, if the government decides it is going to continue with the need for these certificates beyond 2030, what's that going to do with the price of those certificates? Rather than falling towards zero in 2030, what's going to happen then? Yeah,
look, obviously it's we're seeing a lot more voluntary demand for those certificates. I think the demand from the compliance from the scheme is about 33 million certificates a year. I think our voluntary demand is getting up well over 10 million certificates a year over the next few years. So voluntary demand is becoming a bigger factor, but obviously if the compliance requirement for retailers goes to zero in 2030, then the price, that will have a very big impact on the price. Now, there are lots of markets around the world where the voluntary certificate market can support higher prices. So we're seeing in Europe more and more higher prices in certificates being supported by a purely voluntary market. But definitely that will be an inflection point in the market if that change does take place and the 33 million certificates per year compliance requirement goes away.
Sorry, David, again, just a follow-on question.
Yeah.
That should mean, I would imagine, that as a trader, leading up towards that 2030 position, there's a huge risk that you've got, or any company that deals with the energy sector, the energy sectors, there's a huge risk that you've got from a regulatory point of view. So it's a regulatory risk that you're going to have to manage, and you don't know which way it's going to go. Yeah, look, it is absolutely. I mean, our business, like a lot of businesses, has offtakes that go beyond 2030. So if that regulatory requirement does materialize, I think businesses have set themselves up because they need the power beyond 2030. They know that. So a lot of them are having to sign up the power now, whether or not they need the certificates. It's for that reason they would have them if they needed them. But it's yeah, look, as we come closer to that, particularly for a business like us, which retails to a lot of businesses, as we start to get into that 3-4 year contracting window, it will be useful to have some certainty on that. But I suspect, I hope that we get that in the near future.
All right. Well, thank you. We're now at time at 1:30, and I realise there are some questions online that we haven't got to, but I apologise to our online participants for that. thank you very much for participating. Thank you, Keith, for a very, not only well-informed, but a lived experience of trading in the market. This is not theoretical. This is something that Keith does as a living. And thank you very much again for coming down from Brisbane. Thank you for participating. Please participate in the future webinars and in person. We hold them regularly and we hold them to inform. So we hope you will go away with a better understanding and a deeper understanding of the energy market. And thank you again.